Okay, so thank you guys for coming today. We will try to discuss about a financial crisis triggered by a US bank's heavy investment in long-term bonds and securities, which results in significant losses when interest rates suddenly rose, which leads to panic and also market downturn. So in this discussion, we will try to be focusing on the ethical side from each parties. So to sum up about the cases, let's say there's a Bank X. So Bank X is actually one of the largest US bank before its collapse, and it's known to finance and help those venture capitalist-backed startup companies, and it backed up half of all US venture-backed technology and also healthcare companies. So in 2020, because of the COVID-19 pandemic, deposits tripled in 2 years into 189 billion as businesses deposit more during the pandemic. And due to this, Bank X reached its most profitable year ever in 2021. And using that money, they bought tens of billions of dollars of longer-term US treasuries and also government-backed mortgage securities, which is supposed to be considered safe. But then again, Bank X held to maturity securities rose about $100 billion in under a year. But after that, all of a sudden, interest rate rose. So as we know, when interest rate increase, bond price will fall, and thus Bank X experienced huge losses. And their fair value are worth $17 billion less than their book value. Not to mention, with the increased interest rate, the new deposits also shrank. So they have a liquidation problem. And on March 8, 2023, Bank X decided to sell a large chunk of their securities at a loss of $1.8 billion to cover the decrease in the deposits. So not only them, but also other banks like crypto-focused bank also announced their liquidation. And due to this, a lot of investor panic and also a huge number of startups started to withdraw their money at the same time. And this makes stock prices went free fall as customers tried to withdraw the $42 billion in deposits at the same time. So there is a significant difference in holding long-term bonds. So the longer we try to hold the duration of a bond, the more its price drop when rates are rising. So what are we going to discuss today is also about the stances on the public accounting firm. Let's say it's public accounting firm X or PAFX as the auditor, and does this breach ethical conduct in the accounting profession or not? So as we know, the PAFX has been auditing Bank X since 1994 until today. And although in the United States there is no mandated rotation after 5 years about the accounting or auditing firm, it's also widely acknowledged that the longer an auditor serves, the greater the threat to audit quality arising from a loss of independent thinking. So in Indonesia itself, according to OJK, you kind of have to, a company can only audit a company for a maximum of 3 consecutive financial years. So the problem right here is that the PAFX signed off on Bank X 2022 annual report 2 weeks before the market default, but then they give unqualified opinion. So this raises a question about whether or not they're being competent or independent, because like how could 2 weeks after they sign off unqualified report, then they go into default? So on another point of view, we will also try to discuss about the ethical theories from the company's management, from the accountant of the companies itself, because they try to classify their bonds as held to maturity, which allows the bank to exclude unrealized losses on those holdings from its earning, equity, and also regulatory capital. So this also triggers a question about whether or not this classifications is a breach on the ethical conduct or not, and do you think they deliberately do it to fool the investors into thinking their financial condition is fine? So that's kind of the thing that we're trying to discuss today. So in order to start our discussion, I would like to give a question. Do you guys think that in this case, the public accounting firm X in this case breached ethical conduct in the accounting profession? Maybe from Latisha first.
Okay, so from my perspective, I think the PAFX may have breached ethical conduct in the accounting profession in the problem. And there are some points to consider. The first one is the lack of independence. We know that ethical conduct in auditing requires auditors to maintain independence from the clients. And PAFX's long-standing relationship in spanning 3 decades could raise concerns about their independence. Auditors should only be independent in fact, but also be perceived as independent to maintain public trust. And I'm going to also mention about their failure to detect material misstatements. We know that the ultimate responsibility of auditors is to provide reasonable assurance that the financial statements are free from material statements. And in this case, the financial condition is deteriorated rapidly after the audit. And PAF Acts failed to identify these material misstatements, and it raises questions about their competence and due care. And the third one is about their professionalism, skepticism. We know that auditors are expected to exercise professional skepticism when conducting their audits. And given the subsequent collapse, shortly after the unqualified audit opinion, questions could be raised about whether PAF Acts applied sufficient skepticism in their assessment to the financial health of the company. And lastly is the failure to identify the risk. We know that ethical auditing requires auditors to assess and communicate significant risks. And if PAF Acts did not adequately identify or communicate risks associated with the financial condition of the company, it may indicate a breach of ethical conduct. So that's it about me. So what about Amanda?
So I have a different side of view from my analysis. So I don't think that here PAF Acts in this case does breach the ethical conduct in the accounting profession, since as we know there are 5 characteristics. So the first one is integrity. I do think that the PAF Acts is one of the world leading professional services firm, one of the big 4 company, and here they are provide the audit, tax and advisory services to many of the world's leading organization. And one of the company core value here is that they act with integrity. So it represents that the company signifies a commitment to ethical behavior, honesty and responsible conduct in individual or organizational activities. The second one is the objectivity. So in PAF Act's Code of Conduct, they also mention that the company is committed to maintaining independence and avoiding conflicts of interest or undue influence. So I do think that here they follow the objectivity. Also, the third one is the professional competence and due care. It is mentioned in their code of ethics in terms of work quality that the employee should perform their work with high level of care and competence expected by their people, clients, and the capital market that they serve. So this is also follow the ethical conduct. And the fourth one is the confidentiality. So the company here also mentioned that they preserve client and business confidentiality and privacy, indicating that they will keep the information confidential to their company. Also, they conduct the professional behavior as well as according to the Sarbanes-Oxley Act of 2002, they introduced that there are mandatory auditor rotation for public company. So under this law, basically the audit firm here are required to rotate their audit partner every 5 years. And in this case, PAF Acts here is already followed the rule, which is to rotate the auditor every 5 years. So in conclusion, I do think that here the company or the PAF Acts here do not violate the ethical conduct.
Okay, so to conclude from Tasha's side, you think that the PAF Acts is breaching the ethical conduct, while from Amanda's side, you think that they are operating in an ethical way. So one thing I also noted about what you guys say is that you guys also raised several points about whether or not they breached the code of ethics, and I would like to delve deeper into that. Do you think that the auditor has followed the code of ethics in terms of the objectivity and also professional competence and due care, considering that 14 days after the public accounting firm X published the unqualified opinion, Bank X went bankrupt almost immediately? What do you think, Wanda?
So from my point of view, yes, I think the auditor has already followed the code of ethics for professional accountant or IFAC in terms of objectivity, as I mentioned before, in the case that the PFX here said that it conducts its audit in accordance with professional standard. So from the news that they stressed that audit opinions address only financial statement and internal controls, and also based from the audit evidence that available at the date of the opinion. Also for the competence and due care, all auditor in PAF Acts here is already undertake several examination to test their competence, as well as previous experience that they already built to build their competence. So in this case, that I think the auditor here argue that they already being objective, and they're also being competent in handling this case. So in fact that this is the case that the auditor cannot anticipate, and I think this scenario is quite extremely remote that can lead to bank acts here bankruptcy.
What about from Latisha's side?
So we know that PAF Act's objectivity is obviously being tested here, as auditors' objectivity is crucial in providing an unbiased opinion. And the fact that Bank X went bankrupt shortly after PAF Act's unqualified opinion may raise questions about the independence of the auditor. And it could be argued that PAF Acts might have had financial incentive to provide a positive opinion for Bank X, such as the fees they were earning from Bank X for their services. And other than that, auditors are required to perform their audits with due diligence and care. If Bank X's financial condition deteriorated rapidly within a short period after the audit, it might be argued that the auditor should have been more diligent in their assessment and possibly detected signs of financial distress earlier.
Okay, so I think it's a very valid point from both, but like other than the code of ethics, in terms of maybe the independency, which I think Tasha also raised in the beginning, due to the fact that they've been auditing the company for more than 3 decades, do you think that the public accounting firm X maintain independence and also objectivity through its long-standing relationship with Bank X? Because like as we know, there might be like a potential financial interest, considering that they might be trying to maintain the relationships that they've been cultivating for a long time. What do you think, Amanda?
Okay, so my point of view here is that the PAF Acts already maintain the independence and objectivity throughout their long-standing relationship with Bank X, because as I mentioned from the first question before, that they already conducts their audit in accordance with the professional standard. So it's also mentioned that the audit opinions from the PAF Acts here does address only the financial statement and internal controls that are based from the audit evidence that available at the date of the opinion release. So I think in this case the PAF Acts here does maintain their independence as well as being objective. Not only that, also as I mentioned before, the law, according to the law, the audit firms is required to rotate the lead audit partners every 5 years, which already done by Bank X. So they basically rotate their partner every 5 years, indicating that there is no violation over the law or indicating that there is no violation over the law regulation in the US, also the ethical conduct.
Okay, what about from Tasha?
Okay, the fact that PAF Acts had a long-standing relationship with Bank X, it may raise concerns about their independence. And in this case, PAF Acts financial interest in the Bank X account in terms of audit fees, consulting services, or other financial ties could potentially compromise their independence. Auditors are supposed to be independent from their clients to provide unbiased opinions. But in this case, financial interest can create a conflict of interest where auditors may be reluctant to report unfavorable findings that could jeopardize their income. And situations where a client represents a significant portion of an audit firm's revenue, there may have been pressure to retain the client at all costs, and this pressure to keep the client happy might lead PAF Acts being less critical and less objective in their assessment of Bank X financial statements.
Okay, so from the side of Amanda, you don't think there's any ethical concerns considering that they already tried to follow the regulations, while from Tasha, you think that even though they've already followed regulations, it might still raise an ethical questions. So maybe to delve deeper into that from the side of the public accounting firm itself, as you say, they say that they've done their best in auditing Bank X, and any failure caused by conditions after the audit report are not their responsibility. What do you guys think about it? Maybe we can start from Tasha.
For me, I think we know that auditors are expected to exercise professional skepticism and critically assess the information provided by any client. And if PAFX knew about the unrealized losses in HTM securities due to the Fed's interest rate hikes, it could be argued that they should have been more diligent in evaluating the potential impact of these losses on Bank X's financial health, and failure to do so may indicate a lack of professional skepticism by PAFX.
Okay, so what do you think, Amanda?
So I think while PFX here was aware that the high unrealized losses on the held to maturity security had accumulated the unrealized losses due to the Fed action by increasing the interest rate, but they couldn't predict the extent of damage caused by depositor collective panic here, which was I think the most influence is from the social media. But so without the influence of social media, I think the bank might have explored alternative strategy to weather the crisis and may not have experienced such as devastating outcome. So I do think that social media here does make a significant impact over the bankruptcy of the bank.
Okay, so I think both of you argued about like the responsibility of the auditors, whether or not they should have been talking about the risk of the increase in the Fed's interest rate. So this kind of makes me wonder, to what extent do you guys think is the auditor's responsibility to disclose potential risk in their audit report? Maybe from Amanda?
So I do think that here the auditor are required to comprehensively evaluate and communicate the significant risk that could have an impact on the bank financial statement, encompassing aspects like financial stability, regulatory requirement, and other factors that are pertinent to the stakeholder. But disclosure here should be in accordance with the auditing standard and regulatory requirements. So in this case, the auditor already conduct its audit and it's already in accordance with the professional standards. So as I mentioned, that the audit opinions address only from the financial statement and internal control and are based on the audit evidence that are available at the date of the opinion release.
What about from Tasha?
So for me, while it's not certain that ethical breaches occur, the possibility of asset reclassification and a lack of transparency raise valid concerns. And we know that the external factors such as policy changes can indeed impact financial institutions, but clear communication with investors remain crucial. And the lack that transparency and potential motivations behind the asset reclassification should be carefully examined, that we know that it's not manipulated by PAFX. And my final stance aligns with the need of further investigation to determine if ethical breaches occurred and to ensure that financial reporting and auditing standards were upheld.
Okay, so I think we already get like a pretty clear idea about each of your stances about what kind of things should be disclosed. But other than that, I want to ask also about what do you guys think about the fact that they've been maintaining relationships auditing for 3 decades. Like technically in terms of the regulation they're not wrong, but do you guys think in terms of the regulations it should be revised to limit the number of years that a company can use the same public accountant for independency?
Okay, so I do think that the regulation in the United States regarding the auditor rotation every 5 years is already effective due to two main reasons. So the first one is the continuity and consistency. So having a stable audit firm that can provide continuity and consistency in the audit process is one of the key, because frequent changes in audit firms might disrupt the audit process, and it could make it challenging for the auditor to develop a deep understanding of the company operation as well as the financial reporting. The second one is the high cost and disruption. So by changing audit firms, I think it's quite complex and costly process involving significant time and resource needed. So requiring firms to rotate partner but not the entire firm will help the company to avoid frequent and costly disruption to the audit process.
What about from Tasha?
Okay, thank you, Amanda. But I think over a prolonged relationship of 3 decades, it becomes increasingly challenging both for the auditor and also the client to maintain independence and also objectivity. In this case, PAFX might become too close with the client, and it may lead to the risk of overlooking the potential issues or being hesitant to challenge the management assertions. So that's it.
So we're actually talking about a case of a company in the US, right? So I was just wondering about how is it in other countries? Do you think most of them limit the number of years a company can use the same public account?
Okay, so I have one, and I have two examples for this case, which was the European Union and the United Kingdom. So first, the European Union, they have implemented regulation related to the auditor rotation, and they require mandatory rotation of audit firms for public interest entities every 10 years, with the possibility of extending it for another 10 years under certain conditions. And for United Kingdom, in the UK, the FRC, or the Financial Reporting Council, introduced the mandatory audit firm rotation for FTSE 350 companies, requiring them to put their audit engagement out to tender at least every 10 years. And this initiative aims to promote competition and enhance auditor independence.
Okay, so from my point of view, I have 3 examples that was implemented by the auditor. So in United States, India, and South Korea, they both have the same regulation for the auditor rotation. So under their law, they introduced the mandatory auditor rotation for public company that are required to rotate the lead audit partner every 5 years. So I think that this is also supporting my point of view before that it is ethical for the bank acts to conduct these activities.
Okay, so thank you so much for both of your perspective, guys. It was an insightful discussion on the side of the ethical breach from the side of the public accounting firm. So I think it's time we move on into the side of the company's management. Maybe in terms of the classifications on held to maturity, because I think a lot of the news also talk about the fact that maybe it is an act of trying to make the investor thinking that they have like a financial stability. So do you guys think in terms of the classification on held to maturity bonds, is it a breach to the ethical conduct of accountant or not? What do you think, Amanda?
I think as I mentioned before, I do not think that there's any problem with the ethical of the company management, as it is not violating any regulation and it is legal. And in here, the company also follow the appropriate accounting standards and regulation in terms of determining the classification of financial assets. So I stances that it is not considered a breach of ethical conduct as well as the law regulation.
Okay, so what about from Tasha's side?
For me, from the perspective of the company's management, changing the classification of assets from held to maturity to amortized cost especially if done with the intent to manipulate financial statements, can indeed be considered a breach of ethical conduct as an accountant, and it must be investigated further, as they might be fooling their stakeholders of the company to appear more appealing.
Okay, to further question your opinion, do you guys think they deliberately do it to fool the investors into thinking their financial condition is fine, or do you guys think that in this case they are being right, like they do think that they will hold the bonds until maturity?
I do not think that the company are deliberately classify this as held to maturity to potentially fool the investor, since the bank or the company here must have vested interest in maintaining their investor trust and confidence over the years, and I do think that deliberately misinterpreting their financial condition just to fool the investor would not only be unethical and illegal, but also could potentially bring a disadvantage for them in the future.
What about from Tasha?
For me, while it's not certain that the classifications were intentionally made to mislead the investors, the possibility cannot be ruled out. The reclassifications of assets, especially if it was done without a clear and justifiable reason, could raise concerns about the transparency and ethical conduct. It is important to investigate their motivations behind such reclassifications. And if the reclassifications were made without proper disclosure and explanation, it could be seen as a breach of ethical standards, as investors rely on accurate and transparent financial information to make the informed decisions.
Okay, so to sum up, you still think that it's not an ethical breach, considering that it doesn't breach any law regulations, and also from Tasha's side, you think that we should delve deeper into the intentions of the management, because maybe it doesn't breach the law, but maybe they are doing that to fool the investors. So other than the side of the management itself, I also think that a lot of people say that this condition is not anyone's fault, so they think that it is a result of a reckless policy by the feds. What do you guys think about it, and is this an ethical problem or not?
From my point of view, I do think that by increasing the rates from the Fed can be, of course, disadvantage for the bank, as well as so I do think that increasing the interest rate by the Federal Reserve can be disadvantage for the bank, as when the interest rate are rising quickly, the longer the duration of the bond and the more its price drop when the rates are rising, because Bank X here had more of its holding in those long-dated bonds. It started suffering paper losses as the bonds declined in value. However, it is not considered unethical because it is conducted transparently, and it is also accordance with the legal as well as the regulatory requirement in the United States.
What do you think, Tasha?
For me, it's plausible to consider that the impact of Fed's policies on the financial condition of institutions as big as Bank X, like if external factors such as interest rate hikes significantly contributed to Bank X troubles, it may not be an ethical problem on the part of Bank X management. However, it is essential for management to communicate these challenges transparently to the investors.
Okay, so do you guys think that in this case, the Bank X management already do their best in terms of trying to create adequate risk management and also communicate their condition with the investor? What do you think, Amanda?
So I think that the Bank X here has already done their best in managing their risks and classified their assets based on the regulation. However, in this case, there are extremely remote scenarios that brought down the Bank X, which is quite unexpected. So from the alternative standpoint, it's crucial to acknowledge that here the Bank X management action may not necessarily signify a lack of ethical conduct or a deliberate attempt to deceive the investor. The nature of the financial sector here, coupled with the unpredictable Dynamics of the market can make decisions regarding asset classification and risk management will be inherently challenging. Bank acts here, their management might have genuinely believed that they were making prudent choices based on the available information and market condition. And furthermore, the audit process conducted by the PAF Acts might have its limitation, potentially missing certain risks and lacking of complete information. And these factors highlight the complexities of the financial industry, emphasize that ethical assessment should be made with an understanding of the circumstances, intention, and challenges that they face, rather than prematurely assuming the unethical behavior.
Okay, so what about from Latisha?
For me, I think Bank X management actions in creating adequate risk management and communicating their condition to investors in the Bank X and PAF X context, it raises significant concerns. First, the lack of transparency, particularly in the reclassification of assets, erodes trust and hinders the investor's ability to make informed decisions. The intentional reclassification of assets, it potentially for manipulating financial statements, this suggests a lack of ethical conduct. And the second one is the failure to anticipate market risks, such as those related to the Fed's interest rate hikes, and not adequately communicating them, questioning their risk management practices. And the third one is the subsequent collapse of Bank X following an unqualified audit opinion and without clear communication of risk can significantly impact investor confidence, breaching the duty to safeguard investor interests. Ongoing regulatory scrutiny further indicates the concerns about Bank X's compliance with ethical standards and their fiduciary responsibility to the stakeholders.
Okay, so thank you guys for your opinion, but before we close the discussion, I would like to ask your final opinion on this matter. Has the discussion changed your perspective on things?
I stand on my opinion that I remain skeptical about whether both Bank X management and PAF X have genuinely acted ethically. The lack of transparency and the possibility of asset reclassifications do raise valid ethical questions, and further investigation for me is necessary to determine the extent of any ethical breaches.
What about you?
For me, I also stand by my opinion that here the Bank Acts already following the regulation as well as not engage in any unethical behavior. Well, I believe that it's important to consider that Bank X management and PAF X may have acted ethically with the best intention. While there are concerns about the transparency and asset reclassification, it must be noted that these actions were met in accordance with the applicable accounting standard and regulation, and not with the intent to deceive the stakeholder or the investor. Therefore, I believe that further investigation should be indeed be carried out.
Okay, thank you. Other than the final stances, I would also like about the key takeaways that you guys think can be taken from this discussion. What do you think, Tasha?
So certainly, from the perspective that emphasize PAF Act's role, it can be noted that PAF Act's actions or potential lapses may have played a significant role in the Bank Act's problem. First, the PAF Act, as the external auditor, had the responsibility to truly assess Bank Act's financial statements and risk factors. Any shortcomings in their audit process, such as failure to detect or adequately communicate risks, can be viewed as a critical factor contributing to the issue. Additionally, the long-standing relationship between PAF Acts and Bank Acts, they raise questions about auditor independence and whether PAF Acts was able to provide an objective evaluation of Bank Act's financial health. In summary, PAF Act's actions or the lack thereof should be closely scrutinized in evaluating the Bank Act's problem and potential ethical breaches.
What about you?
It's worth considering that PFX's role may not have been as pivotal in the Bank X problem as suggested. While PFX is the external auditor, it's important to remember that auditing involves an evaluation based on the information available at the time of the audit. So if subsequent event or undisclosed information significantly impact Bank X financial health, it might not necessarily be a failure on PAFX part. Furthermore, the long-standing relationship between PAFX and Bank X could also be viewed as a positive factor rather than negative, indicating a deep understanding of Bank X operation rather than an inherent conflict of interest. Therefore, in evaluating the Bank X problem, I think it's essential to consider a broader perspective and not solely based on the attribute the issue to PAF action or independence.
Okay, thank you so much all for engaging in this insightful discussion. We've explored various perspectives on the roles of the public accounting firm and also the Bank X management and also external factors like the Federal Reserve policies. So from this, it is evident that while regulatory compliance plays a significant role, ethical conduct remains a crucial aspect in maintaining public trust and also investor confidence. So this case underscores the importance of transparency, independency, and also due diligence in the financial industry, and also prompting us to continuously evaluate and also enhance ethical standards to be able to safeguard stakeholders' interests. So thank you so much for the contributions, and thank you for your participation.
Thank you.
Thank you.